Welcome everybody to today's panel discussion, deal making during the pandemic. I'm Joe Volman from Burns & Levinson. On behalf of my Life Sciences co-chair, Andy Merkin, who'll be moderating our panel, and the other Burns & Levinson colleagues that are in attendance, I want to welcome you all to this, what we hoped is a very informative, interesting discussion. We have a great panel, a group of panelists, investors and entrepreneurs who can talk to you about what's happening right now during this pandemic. We have 140 folks in attendance, by the way, so very pleased with the attendance and thrilled to have you all with us. I know there's lots of friends and clients in the audience, so many of you know us, but for those of you who don't, I'm going to give you a little bit on Burns & Levinson. We are a full service firm predominantly based in Boston. I co-chair the corporate law group, and then within that group, I co-chair the life sciences practice with Andy Merkin. As I said, we are full service, meaning we have not only corporate and intellectual property and real estate, employment, tax, litigation, private clients, all the areas you'd expect a full service firm to have. But want to highlight really the two groups that I think for those of you who are going to participate in our breakout rooms afterwards, you're going to hear from, which is our corporate group and our intellectual property group. Our intellectual property group, we're really proud of that group. It's a very deep, diverse group of professionals who represent companies in a variety of industries within the life sciences practice area. And the corporate group, which is about 40 of the 135 or so lawyers, represents companies really of all sizes, from startups all the way up to larger public and private companies, as well as investors in those companies, so seed funds, venture funds, high net worth individuals, investment bankers, et cetera. Happy to say that we had a record year in 19 and started off 20, as many of you did, with a bang, thinking this was going to be another rah-rah year, and had a great first quarter. And then, of course, it all came to a halt, some of which you'll hear about from Andy in the panel. But despite that, during the pandemic, we have been fortunate enough to close some financing deals in the life sciences space and M&A deals, and just did a public shelf takedown. So have still maintained a level of activity. We obviously wish it were a little greater, and start to see some. We're starting to see some activity in the pipeline getting filled up again. But it's really a practice area we're very proud of. We're very proud of the professionals in the group, our clients in the group, and we hope to get a chance to meet all of you. And so, without further ado, let me turn it over to I'll just say a brief word about Andy, which is he and I have worked together for nearly 20 years, and have had a great run together. We've tried to build this life sciences practice together. He too comes from a background of deal making within life sciences and has great depth and breadth of expertise and a terrific client base. So we couldn't have had a better moderator, someone to put this panel together. So take it away, Andy.
Well, thanks, Joe. I think I owe you a couple of beers when we can actually get together in person again. So welcome, everybody. Just quickly to add a little bit to what Joe was saying. We're really thrilled to be able to share today the experience that we've had, but more importantly, the experience that our terrific panelists have had during this pandemic in terms of deal making, how things are changing, both short-term and long-term. Joe did make the comment, we were really looking forward to ultimately being able to see everybody live in person again. As our friends know, we host several different networking events during the year. We do a kickoff cocktail party at JP Morgan. When Bio is held in Boston, we do one similarly down at the waterfront in Boston. In the past few years, during what's now called Boston Biotech Week, we have held also a, generally speaking, networking only outside in the Seaport event, which we love doing. We love seeing people, but more importantly, gives our clients, contacts, and friends the chance to network, meet each other. We all know that in the life sciences space, more so than any other industry, things are done via connection and collaboratively. And it's these types of events, whether they're in person or today virtual, that allow us to share that opportunity with people. As Joe mentioned, we've got 140 people registered from all over the country. These are people in all different areas of the life sciences and all different aspects of companies and investment banks and venture capital firms. So again, welcome, and we're thrilled to be able to virtually see everybody today. I will now just quickly introduce our panelists. The three panelists, and they will introduce themselves much better than I will, are Tom Miller of Graybird Ventures, Ben Conway of Concilium Partners, and Randy Scott of HealthWest Capital. So we have one investment banker and two venture capital investors, but as you'll hear, each of them also crosses over into some of the other areas. So with that, I would turn it over to our panelists to give us a little bit of background and then to filter directly into one of the initial discussions.
Great. This is Tom Miller from Graybird Ventures. We are a somewhat unusual venture firm. We're the world's largest dedicated diagnostic investors. We're also the world's smallest dedicated diagnostic investors, since almost no one does that. And that was an area no one paid much attention to until it turned out it's pretty important. So next slide, please. We fairly new firm. We made our first investment only in early 2016. We were founded by three guys. There's Michael Devlin. He's a banker, lawyer, and American who speaks fluent Mandarin and Cantonese. Scott Gazelle, who is an academician, Harvard professor, physician, founder of the largest institute to assess the clinical and diagnostic efficacy of new technologies at Mass General. And me, I'm a sort of an operating guy. I've run very big things with 26,000 employees and very small things like startups with 12 employees in between. And of course, the brains are a bunch of operating advisors who have really stellar resumes. Next slide. Well, we invest exclusively in diagnostics with a capital D, anything that helps characterize a human's biology or physiology. So that can be imaging, information technology, or in vitro diagnostics. We invest early, typically A rounds. We have led every investment that we've made. In fact, we've been the dominant investor in every investment we made. We are not focused on any geography. We have companies in the United States, in Europe, and in China. Investing there is not for the faint of heart. Our investment range goes from a small of 4 million to a large of 10, may go larger. And we tell all of our CEOs that we are the opposite of passive investors. We are very active in all of the companies. Next slide. And one thing that makes us different is we're a bit manic when it comes to understanding the space we're in. We maintain the world's largest database of early stage diagnostic companies and curate it. Together with RA Capital, we produce diagnostic landscapes in order to understand the whole world of areas like cancer diagnostics, infectious disease diagnostics, diagnostics around cardiovascular disease, et cetera, and use this to inform our investing decisions. And that's it for us. I look forward to an exciting webinar.
So this is Randy Scott. Next slide, if you would. Yeah, I'm with HealthQuest Capital. We're what we describe as a venture growth investor. So we invest in revenue stage businesses across the healthcare spectrum. So that's medical device, diagnostics, healthcare IT, digital health services, consumer health, anything that's healthcare or medically related, as long as it's revenue stage and positioned for growth. We invest really anywhere, but certainly all across the US, and we pay particular attention to some of the kind of underserved parts of the country, like the Southeast, the Midwest, the mountain states, but also invest in Silicon Valley and Boston and what have you. We've got a distributed investment teams. We have 8 investors. Headquarters is in California, the Bay Area, but I'm based down in Florida. And we also have folks in, 2 of us here in Florida, in Atlanta, Philadelphia, Austin, San Diego, San Francisco. So I kind of cover the country. Currently making investments out of a $450 million fund. Typical check sizes can run anywhere from $10 to $40 million. We'll go to Ben next.
Perfect, Ben.
And thank you. I'm Ben Conway, Concilium Partners. I'll give you a bit of background, but then let's just jump into the slide deck that I prepared just to set the stage here. Concilium Partners, we are a tech-focused middle market investment bank, 20 years, excuse me, 20 years old, founded by ex-Rabbi Stevens bankers. The life science practice, which I'm the head of, we are involved in transactions across a wide range of industry, of companies in the industry with both products and services. The deals we do include both buy-side and sell-side M&A, as well as capital raises. Of note is that we have significant U.S. activity. So with that, let's skip through this slide and skip through the next slide. Those are the overviews of our practice. And let's get into the real meat of the discussion. I'm going to quickly go through these, and then we'll open it up for conversation. Obviously, coming into the pandemic, venture activity in the life science soared. Now, next slide, please. That said, that had been driven largely by the receptive public market environment. As you can see, in both 18 and 19, we had huge levels of money raised in IPOs. So then next slide, please. Importantly, life science deals have become an increasingly prominent part of the overall new issues market. Again, highlighting their prominence. Next slide, please. COVID-19 hasn't stopped that momentum. As you can see, in 2020, annualizing the performance through today, or through the first half, we're looking at a significant bump up even for over the past 2 years. In fact, we're heading for a record year. Next slide, please. So if we look at the overall dynamics and what we see as the outlook investment perspective, we see new venture funds, in fact, forming, albeit selectively, but the whole sector appears to be benefiting from a COVID-related halo effect, where the idea that the pharmaceutical space certainly, and much of healthcare was under this price magnifying glass. Currently, though, we are seen as the heroes, as the group that's going to save us all from COVID. So from an investment perspective, it's as if we're saying, COVID-19, bring it on. Now, next slide, because that's going to sharply contrast with what we're seeing in the M&A space. Next slide. So from strictly a numbers of announced deals perspective, we're looking pretty good, I'd say, right? In fact, if we look at the number, and I don't know if you can see it here, I think there's been something that's been cut off the bottom. In fact, though, the number of billion-dollar deals announced has dropped sharply over this period. In fact, it's gone from Q3, where there were 6 announced deals, to 5 in Q4, to 3 in Q1, to $1 billion deal announced so far in the second quarter. So this is quite a sharp decline. And what that signifies is that there's little appetite for risk, and no one is willing to make a big bet right now. And that follows, next slide, please, a sharp decline in M&A activity that began well before the COVID-19 outbreak. And next slide. And deals that are getting done increasingly are structured deals involving earn-out milestones. Again, the theme here is that hedging risk is front of mind. Next slide. So in contrast to the IPO market, M&A really is at a large standstill right now. We're waiting for clarity on the market's continued direction, future direction, and while there may be some pruning in venture portfolios, even then the appetite of the buy side is going to be uneven. It's going to be where they want to place their bets. And my belief is that after all this is eventually settled out, the M&A market, and this is going to follow the current trends in the IPO market, is likely to favor later stage companies with development candidates in these later stage development stages, if not marketed products outright. So with that, I'll turn it back to the panel.
Great. Thanks, Ben. That was great. Hopefully you had a chance to catch your breath. I know you covered a lot in a little bit of time there, but to our guests, we will drill down a little bit more into some of the aspects of what Ben was going over as we're doing our questions. One thing I had neglected to mention at the beginning of the webinar is that if you have questions as we're going through, please submit them through the Q&A function. And then when we get to the end of the panel, we will have Q&A, and depending, we will pick as many of those questions as possible. So please do that. Just following up on what Ben was discussing, we're going to talk a little bit first about M&A, and then we will pivot to venture financing. So again, just looking at what's been going on in the M&A markets, can the panelists have any thoughts on how the COVID-19 crisis has impacted deal activity in both of terms, the numbers of deals and also the timeline from kickoff to closing, which is a question that we're getting all the time from people.
So maybe I can, first of all, speak to the diagnostics industry. I'm a very narrow, limited person, so I can only speak to that one segment. But we see a bimodal thing happening. If you happen to have technology that could be relevant in the short term to COVID-19, I mean, we have our own companies, I know of a couple of others who are never expected to be approached for any potential M&A activity, and all of a sudden they are front and center. On the other hand, I see exactly what Randy just said. If you're not, we had two companies involved in discussions, preliminary discussions. Those discussions just got shifted out, for who knows when. And part of it is due to very practical reasons. One of the companies was looking at technology for a nursing home. Well, you can't do a deployment in a nursing home now. You can't even go in a nursing home now, right? Another was waiting for results from a clinical trial on oncology. Those clinical trials have ground to a halt. I mean, patient recruitment has gone to hell. So, I think it's very much bimodal, with a little thing in the middle of weird stuff going on around technologies that are trying to promote themselves as having been related to COVID-19, which have nothing to do with COVID-19. But that's an anomaly.
Yeah, I think that's to chime in there too. I think that there is a interesting dynamic of two sides of this coin. One is, I completely agree. I think any active idea of doing an M&A deal during this time period, for the most part, just got iced because people are like, too much uncertainty. We're going to hold on to our, even big money or big companies going to hold on to our cash and whatever. There was all that kind of dynamic that was going on. So I think that's A. And then B, I think there's also a perception as people in our industry look back at 2009 or whatever, and they look back at 9/11, and they say, okay, well, both of those instances, private company valuations, the nadir, the low point of private company valuations were probably 6 or 9 months after the event, if you will. And so there may be some tendency to want to wait and see if maybe deals get a little sweeter or whatever. But meanwhile, of course, I don't think there has been any readjustment of valuations at all, because the public markets have defied gravity. So why would anyone change their expectations? So there's all those dynamics. But on the flip side, everybody's been at home, not on airplanes, lots of extra time on their hands. So I think the amount of early conversations, sort of networking with the corp dev people and all this kind of stuff, I think that has been through the roof. And that will probably come back to roost in a positive way. My guess is in, whatever, maybe end of this year or first half of next year, whatever. So there's been a bunch of conversations that have started and been able to advance at least to a certain point that maybe would have taken, 6 weeks to get a call on this calendar before. Maybe somebody wouldn't have even responded to an email before because they're all too busy. So I think there's those two conflicting dynamics going on.
Randy, that's actually a very interesting point that I know we're going to touch on a little bit later in terms of companies and investors, buyers not being able to actually meet in person and the impact of that. You mentioned, from what you're seeing at least, that transaction value has remained robust and hasn't decreased. I'm wondering,
I'll say transaction expectations.
Okay.
There is no transaction values to point to.
That's
Okay,
true.
so Ben or Tom, are you seeing that as well? And to any of you, it sounds, Randy, like you're suggesting that, at some point in the future, just based on the lag, that when transactions come back, the valuations are going to be down. But if I heard that correctly, but I'm interested in what anybody thinks on that.
Yeah, no, absolutely, and I would agree that on the one hand, but it's a bifurcated picture because on the one hand you've got the sellers who are looking at the public markets for comps and trying to get direction from them, and the public market value sky high, and you're scratching your head as everybody else does. When you're looking at what the future might hold on the and even the big private equity groups that I'm talking to that have said, look, we're telling everybody, look, there's been no change in value. I think there's a lot of expectation that there's going to be a quick fix to this. A vaccine's right around the corner, et cetera, et cetera, et cetera. So, so that's on the sell side. But on the buy side, no one's moving. So, again, the interest is there. The appetite for the is not. And I will say, as I was mentioning in my opening comments, you saw the level of M&A activity dropping off sharply over the past several years. That in large part, was driven because of valuation concerns. That and the reason that you're seeing more structured deals, all great part valuation driven, but so that's you're going to see delays.
Yeah, somebody's going to have to capitulate. We just don't know who yet.
Yes.
No, it's interesting. I would have expected to have heard, and from what we're seeing, although more on the venture side, the M&A side, that discounts to valuations and such. But it's great to hear, at least for now, that they haven't taken a hit. Although you're suggesting that it's certainly to come. So let's talk a little bit about the deal process itself. And my question is in terms of and at least one or two of you had gotten into this a little bit. Financial due diligence, including review of financial projections as part of the due diligence process. Has that undergone a change at all in the M&A space?
Maybe just a quick comment. I think the entire due diligence process, since we're sort of in the middle of one, it's amazing. I actually think it got more productive. It's having discussions every single night, via Zoom. They've been, no one's hopping on planes, so actually the frequency is higher. Feedback is faster. So actually the process itself has been surprisingly not delayed, with one exception. In another case, people wanted to touch and feel things, so we're shipping stuff. But other than the shipping stuff and the touching and feeling things, that's not happened. We have not had any transactions where the companies involved have been negatively impacted by COVID-19. So in fact, if we were to have an EBITDA and COVID impact, it would actually be for a couple of the companies, the COVID impact would be incredibly positive. But in one case, if they were in question, they're not, it would be negative. I mean, their revenues, crashed during the first months of the year.
Yeah, I think it depends on the product, right? Because there's some areas of the life science spectrum that are essentially data-based transactions. If you think about therapeutics, for example, so you're looking at clinical study results, all this kind of stuff. You don't really need to meet face-to-face to be able to do most of that. And you're buying the asset, you're probably not buying the management team, whatever, I think you shift over to medical devices, it can be very different though, because hey, I want to, get this in the hands of my, KOL surgeons, and I want them to use it on some patients and see, does it, what they think of it and you can't do that. And so I think med device, most of med device at least, is probably completely iced right now. But I would guess that therapeutics and maybe diagnostics, because they're much more data-based decisions and kind of science asset purchases, there's no reason they can't progress pretty well without, having group meetings and traveling on airplanes and stuff.
Yeah, I don't know about that actually. I tend to think that that, Randy, certainly for therapeutics deals, which are later stage, that's certainly the case where if they're not, outright market products, then it's clear. But certainly with companies, and this is what we deal with quite often, with companies with earlier stage technologies, either they're preclinical or they're very early in the clinical development, there's a lot of touchy-feely that I think people want a face-to-face interaction for, that you can't really do that over Zoom. I mean, that's just the sense. So, I mean, what I hear this, in fact, from a number of investors, they're saying, look, we can get it to the LOI stage, but after that, then they slow down. So things are getting put on hold just because of that. There's that personal connection. They want to set to that.
Yeah.
And certainly integration issues. I mean, unless you think we're just jettisoning the whole organization as far as people goes, integration issues, that's really very tricky. That's another big delay.
Yeah, I think the other thing that maybe slows things down a little bit is there's reduced FOMO, fear of missing out too.
Right.
And so people are willing, they figure out nobody's really going to do much deal making right now, so we can drag this thing out. And, whatever, maybe a few more experiments will happen, or some material adverse change will happen or something. In the meantime, we'll be glad we waited.
So let me ask you, and Tom touched upon this a little bit, have any of you seen the formal use of the new phrase EBITDA, earnings before interest, taxes, depreciation, amortization, and coronavirus? Tom, you mentioned it's sort of, it's being factored in, it's coming out naturally just because of how it impacts the business, but are people actually applying this as an analysis tool, or is it more just a little bit on the fly?
So, I mean, I'll just say, there are two cases we have, and some others that I know about, where the companies have been negatively impacted. So, and I can speak to one of our companies, our Chinese company. As you might expect, our Chinese company, from January to March, their revenues went to zero. They're just plain zero. I mean, these are early stage companies. So last year, the revenues was slightly over 2 million, but they expected to double that this year, and then they went to zero. So that was tough. But just this morning, with the reopening of the Chinese economy, hopefully it doesn't close down again, they announced 3 very large deals and still are holding to their expectations. So it could be that their latter half is the same, but there is going to be every sort of song and dance around revenue projections and earnings that people can make to make themselves look good, right? I mean, and some will be real and some will be not so real.
And let me just throw, sorry, Randy, I don't want to interrupt. Let me just throw this out, and there may not be an answer to this, but what would all of the 3 of you think is going to be the trigger point for things, say, coming back to normal? Is it a vaccine out, on the market? Is it just, very, very positive changes to the numbers of infections? At a very high level, what do you think will be the pivot point?
Well, I think, an announcement of a vaccine obviously would be huge, or for that matter, just a therapeutic. And of course, there was a recent announcement on something there too, but a therapeutic that was, mass producible and effective even, I think helps a lot also. I think your question is a little biased in that it seems to presume that things that there will be a triggering event and they will return to zero, which I actually think the market is assuming, but I'm not so sure is fair to assume personally. And I think a couple of announced failures of vaccine trials, which could just as easily happen, could be, really painful.
But vaccine production, I mean, it's going to take time, and it does if you're going to do it right and know that you have a good, however you want to define good vaccine. It takes time, and there's nothing you can do to change that. I mean, and especially if the cases were to come way down, then it's just going to take longer to figure out whether the vaccine works or not. So I'm not so sure that the vaccine. I mean, look, I think the market has a lot of belief, of enthusiasm for the idea that we're gonna have a vaccine near term. It ain't happening. I'll be quite frank about that. Or at least I'll say there may be a vaccine, but I'll stand in line to get that vaccine right after our president.
Yeah.
I'm not so sure people are going to be really enthusiastic to get it.
That's a fair point. Everybody on the trigger or the pivot point. It's the eternal optimist to me that always comes out with that. So let's take a half a step back, and I wanted to drill down a little bit more to the extent that you are seeing deals. And Ben, it sounds like you're seeing more sort of sell side push than buy side, if I heard that correctly. But correct me if I'm wrong. What are you seeing COVID related changes to terms, COVID-related reps and warranties, changes in the tranching of deals in terms of, on the M&A side, obviously, earnouts and milestones, language in the force majeure clauses that we lawyers all come to love, things along those lines.
Well, given that the big deals just aren't happening, I haven't seen anything actually, but I mean, as far as the deals that are getting done, these are going to be the smaller tuck-ins, the add-ons, the bolt-ons. There are in fact a number of reverse mergers going on where companies, are getting public, I guess, following the coattails of the IPO window, but doing that through reverse mergers. So yeah. When you talk about, are you seeing different deal structures? I mean, the one I highlight was the deal that was just announced yesterday, Gilead's acquisition of Pioneer. That's an interesting one. It's on the immuno-oncology side. But that deal was structured, and not that you haven't seen this before, but here in these times, I think you're more of it, where it's structured as an exclusive option, where Gilead went in and paid $275 million for a minority, a significant minority, but a minority stake in the company with the option post phase 1B results, acquire the rest of it, and then pay, of course, certain milestones and earn-out payments with that. But I think you're going to see more of that. It gets back to this idea that I was discussing in the upfront presentation. People are looking to hedge. They're looking to hedge the exposure they have. And Gilead, I mean, look, Gilead with remdesivir, they're front and center. So if anyone feels like they have some wiggle room, I would imagine Gilead and perhaps Moderna and whatnot. But I mean, that's what you're starting to see people factor.
Right. So that's certainly not a new model, but you're saying that you are seeing it and you expect to see it more and more.
Yes.
So I agree with Ben's comments, especially when it comes to structuring deals in order to mitigate risk over time. I think that's right. The place where I disagree actually is, and maybe it's only an N of 2, but it's an expensive N of 2. I actually think that people are becoming very comfortable with a Zoom diligence. One of the companies that we've been interacting with actually asked the question on Friday in anticipation of this webinar. I said, they want to incorporate all the personnel. Retention is a big deal. And it's amazing. I said to them, do you feel the need to meet in person? And they said, no, we know so-and-so has a dog, another person has a little kid. These are things we'd never know before. We're speaking longer and more frequently than ever. We're seeing—
That was my dog, by the way.
but so I actually agree with Randy and Ben that things will not go back to normal anytime soon. And in fact, I don't think they go back to normal forever. I think this is an event that is going to change how we operate.
That's an interesting take on that. One last question on the M&A front, and then we'll shift into the financing side. So anyone who wants to tackle this, what advice would you have for companies as they're considering either looking for a buyer or recently kicked off a sale process? Just what are a couple key points for them to keep in mind as they're starting the process now?
Hey, Well, I would throw out just one thing that comes to mind. This will come up later when we're talking about new investments too. But I think there's historically in our business, a lot of people have waited to key things off of JP Morgan in January.
Yeah.
And I think that looks like a really bad idea right now, because I don't think any of us know, is there going to be a JP Morgan? Is anyone going to show up to JP Morgan, whatever? And is there going to be some other economic shoe that drops, and you throw in an election and everything else? I would say if you think you're going to want to transact in the next 18 months, I think you ought to be out there beating the bushes right now, in part because it is easier to have those early conversations, even the early to mid conversations. Yeah, I get Ben's point about maybe you can't get past an LOI or whatever, but hey, getting to an LOI is the hardest part of the job anyway. I would say you accelerate any anticipated deal-making process would be my advice.
No, that's great advice. It absolutely makes perfect sense. It makes perfect sense. So with that, why don't we turn to venture financing. Some of the questions are going to be somewhat analogous, but I think it's a very different playing field. So the first question is, much like with M&A, is what are you seeing in terms of the numbers of deals that are happening, as well as the timeline of deals from kickoff to closing on the venture finance side under the COVID-19 pandemic?
From my side, once again, it's bimodal, although I have to say there's a whole lot of companies who thought they had financing who all of a sudden don't. It's been amazing the number of phone calls I have had with companies calling us up saying, Tom, you sure you're not interested? And I said, I thought you had your money already. Well, no, I guess I don't. So I think there's been a lot of volatility there. And I think there has been a lot of people who are waiting. I mean, I know two other VCs who I'm close to who basically said, we're going to wait for a little bit to see what happens, because we're not quite sure where valuations are going. And so I think there's a bit of a pause.
Yeah. So
go ahead, Randy.
I was saying we've actually done, since the kind of crisis started or whatever, we've closed 2 deals and we put out or signed on to 3 term sheets. So we've been quite active, in fact, probably a little bit more active than normal. I will say the 2 deals that got done, though, one of them was already in process, so maybe it doesn't count, but we followed through and got it done. The other one was, though, a company, to Tom's point, that had actually intended to do an IPO in the first half of the year, and we had given them a term sheet, what would have been kind of a crossover sort of round or whatever, like last year, and they decided they didn't need it and they were just going to advance to go and collect their $200 or whatever. And then they came back to us and said, okay, well, on second thought, we kind of like to still do that. And so and then we've seen a number of these companies, to Tom's point, that thought they had financing, and there's some portion of the investment community just hit the pause button when all this stuff hit the fan, and so those folks are out sort of searching it. On the flip side, though, we've seen a ton of deals come inbounds, and we have actually had a few instances of just flat out getting scooped on deals where we thought we had plenty of time to act, and the companies got term sheets in 15 minutes or whatever, and we didn't even get a chance to really get into diligence very far. So there still seems to be a lot of activity going on. It's kind of like the public markets. It's a little bit mystifying to me, to be perfectly honest, but stuff's getting done.
But where are you going to put your money? I mean, you talk about, and this isn't just for life science. I mean, it's everything. Where you can put your money? I mean, you can put it under your pillow, lose money there. Put it in bonds, lose money there. You can put it overseas, but that's quite uncertain. So people are flocking to get yield from U.S. equities. I mean, that's what it is. It's just you're not going to put your money in a 30-year note for 1% or whatever it is. That's that, and I got to say, I believe strongly that the Robin Hood effect is playing a factor as well.
Now, Tom, you had touched upon the point about some people sitting on the sidelines because they're waiting to see what valuations are doing. I know we've, in our practice, on both the company side and the investor side, we've seen some deals get put on hold, in most cases because one of a syndicate of investors has chosen not to move forward. And then they come back with a replacement investor, but the valuations have been down. We've seen them anywhere from sort of 15 to 25%. What are you all seeing in your worlds with the deals that actually are moving forward? Randy, in the case of some of these companies that you're saying are having a much easier time finding potential investors and signing term sheets, are they at the valuations remaining steady, or are they lower?
I think the standard distribution or whatever standard deviation of valuations is much broader than you would normally expect. I think is actually what's going on. So we've seen some deals at some super high valuations, and then we've seen a couple that were bargains to where we were kind of asking ourselves, hey, what are we missing here? Because they're all over the board, and I'm not quite sure what the explanation for that is.
Great. Interesting question that has been posed to us a number of times. And again, everybody touched upon it a little bit in the M&A discussion, is in the world of venture financing. In today's world of everything being done virtually, will a VC investor, without ever having met a management team in person, either sign a term sheet, or if they will sign a term sheet, will they actually close a deal? Again, without ever having met management in person, and for those companies where they actually have a site and it matters to see their operations, being able to do that.
My stance, I say yes.
Yeah,
I say yes also.
And I would say that in fact, one of my partners closed just that deal earlier, maybe, last week. I mean, where they were commenting that this was peculiar, that they had never had a deal where they never met the management team before closing. But in fact, that's what happened. They closed the deal without it.
Yeah. I will say on a couple of the deals where we've been working on it, where we knew we weren't going to be able to meet the management team. For example, one in New York, we knew the timeline that the deal had to happen on, and it just was quite obvious we weren't going to meet the team in person, right? And there we actually just told them up front, okay, we're not going to be able to meet. So but the good news is we don't have to spend a bunch of time on airplanes, and my case, whatever. So let's just block out some time on Zoom, just you and me, to the CEO or the top 2 or 3 people on the team. We're just going to block out 90 minutes, and we're just going to, talk about life or whatever, the kind of stuff you do over a beer or dinner or something like that. It works surprisingly well, and you can comment about, well, tell me about that picture, behind you on that bookshelf or whatever, and get to know them that way, I think.
That's that's great to hear. I'm sure people listening in who are on particularly on the company side that are looking to raise are very excited to hear that. It's interesting because a couple of weeks ago, as part of an investor conference a virtual conference that I participated in, I asked that question of several venture investors, and because it's going back only 2 weeks, the feeling generally was that they said unlikely to happen, but it's still early in the process. And one of them actually said, yeah, we would sign a term sheet, we would never close, but if we're still sitting here in December in the same situation and we can't get on a plane, then we've got to, we'll have to assess our strategy, because to the point of, the funds have money that needs to be deployed. And he suggested that things would most likely change at that point, but it was everything was in a little bit of a state of flux. But it's very, very positive to hear everybody say what you are doing or what you're seeing. Let's shift to just talk about some existing portfolios. So for existing portfolio companies that raised capital prior to the pandemic, how is the pandemic impacting both their operations and their ongoing capital needs?
Yeah, I'll start again. Bimodal. I told you about the Chinese company who went to zero and then it's come back again. We had another company where we were anticipating doing a B round later this year, and it turns out the company is probably going to go cash positive due to COVID. I mean, if you had asked me in December, I actually thought that they were undershooting the B round. They were going to need even more money, and voila. So it's really bimodal. There's a lot of, I mean, I'm not sure it's sustainable. That's a different question. But it's if you have a solution right now, there's a lot of cash to be gotten, not only from venture and others, but from government sources and other and things like that, especially if you have a COVID pertaining solution. And not small amounts of money. I mean, rather large amounts of money.
Yeah, I would go so far as to say it might even be kind of trimodal. To go, so you do have some companies have gotten crushed by this, elective surgery stuff, right, for starters, the most obvious. I think because we're in healthcare, there, for example, we've got an investment in a cardiac monitoring company, zero impact one way or the other. People are still going to get their hearts monitored or whatever. And then we've also got some investments in things like telemedicine that are just bonkers. And surprisingly, we've got a couple of investments in the employee benefits space that have done remarkably well, because ironically, employers are spending less money on health claims this year. So they actually have money in their benefits bucket to spend, and the decision makers are sitting around willing to take phone calls. So that was a surprise winner for us. But anyway, it's a mix of all three of those.
Very interesting point. Very interesting point. And just I want to point out to our guests that we have some good questions that are being submitted through the Q&A feature, and I know some of them are very specific to what one of the panelists just said, but we will capture them all at the end in a few minutes, and because again they're good and they're good questions that we could all discuss. Same question that we asked about with M&A. So for companies that are considering whether starting a capital raise or that may have just kicked off a capital raise, what advice would you have for them? I know Randy, mentioned the M&A space. Start now. It's going to take longer. Don't pin your hopes to JPM, which I agree is for everybody in the space sort of knows what that does. Similar types of advice from anybody for venture seekers right now.
What Randy said.
Yeah, no, and I would, obviously it's going to take more time. There are certain logistical considerations, but actually from the investor side, and granted, yes, on the private equity, and when I mean private equity, I'm saying private versus public, there's probably more hesitance to invest right now. They're looking to be sure their portfolio companies are adequately. That said, though, the interest is there, and the appetite. And so I'm not saying that go out expecting you're going to get this done tomorrow, but to see the idea, with a range of investors, to then methodically bring it along, I think is definitely something that's worth pursuing.
Hey, I have actually a question myself for Tom and Ben and you, Andy. So we've seen a lot of deals that kind of don't have that much to do with COVID, but they come in and they've got a deck with their COVID spin on their story or whatever, which personally I find to be a little bit of a turnoff, but I'm kind of curious.
Ditto.
Before we turn to Q&A, just sort of one last, somewhat of a wrap-up question. And everybody touched upon this already to some extent in terms of what you think things will look like short-term and long-term. So I'll just throw out the question at a high level. For both M&A and for venture financings, what is your outlook for the next, say, 3 to 6 months, 1 year out, and 3 years out, to the extent you can even predict at this point?
I'll begin again. Remember, I'm the diagnostics guy. I have to say that when we started Graybird Ventures, no one wanted to talk to us. We had trouble raising money. A lot of times we would say, we're only going to do diagnostics, but we'd hear the door slam. All of a sudden, diagnostics is in the front page of every single newspaper every single day.
Definitely, Tom is sitting in the catbird seat. Diagnostics, and I'm sure Tom recognizes this, has always been sort of the ugly stepsister to the therapeutics. And right now, diagnostics is where you want to be. I mean, we obviously therapies are big, but still, diagnostics, you never seen anything like this. I mean, on diagnostics alone, you see Danaher, you see Abbott, you see Roche. These are massive companies jumping 10, 11, 12% plus in a day, all driven by the idea of that diagnostics. Tom, my hat's off to you. You've done well. Now, but to your question, where are we going to be 3 to 6 months? Well, the way I think the therapeutic, or rather the vaccine programs are going to go, but based on how fast COVID's expanding across the globe, I think you're going to see. I mean, you could even see herd immunity. If you get 6, maybe 9 months, maybe a year out, you're going to start seeing high numbers of people who have the antibodies. Now, whether that translates into the hospitalization percentages and the chaos that we saw back in March and April, that's another story. I think there will be advances in treatment regimens, and that doesn't mean therapeutics per se, but just in approaches and processes, plus the fact that we've been at this for a while now, and will be even more so 6 months from now, so that we'll be better prepared to handle the increasing flux of patients. Not that it's going to be a perfect world. It's not going to be. 3 years, I believe we will be, but.
You know what the amazing thing is, Ben? You say we've been at this for some time. When you think about it, it's only been 4 months. It really,
I know, but it
seems like a lifetime. It really does, but it's been essentially 4 months.
but when we shifted half of the economy now to COVID focus,
it's really amazing. So
and we're living in a time of social media where it's now gone from 15 minutes of fame to 15 seconds of fame.
That's true. That is true. So I'm just keeping an eye on the clock and want to be sensitive to everybody's schedules. Why don't we turn? We've got a few questions that have been posed. So let me just go through these in order that they were posed, and hopefully we can get to all of them. The first question for Tom Miller. Are you and this comes from Michael Henry. Are you investing in diagnostics companies with COVID-19 products or others?
Okay. As I said, we invest in diagnostics with a capital D. So it's anything that helps characterize a patient's biology or condition prior to treating them. And that's for any condition that makes sense. There's only one probably disease that we stay away from because we're really not specialists there, and that's diabetes. Diabetes is almost a discipline unto itself, and that's not where our expertise is, but in our portfolio, we have infectious disease companies, oncology companies, companies that monitor neurodegenerative disease. So anything.
Terrific. The second question, and I apologize in advance if I mispronounce the name, is from Bihan Farangwi, and the question is broadly: how has the focus of investment focused on telemedicine delivery, particularly in conjunction with state government contracts? So what's happening with telemedicine?
Yeah, I can take a stab on that one because we make investments in that space too. So obviously right now, telemedicine through the roof. Everything remotely related to telemedicine is doing well. And I think it's a permanent phase shift. I suspect that as COVID fades behind us, it will come down from maybe the current level, but that whatever the new plateau is will be substantially higher than where it was before. I also think the rules around reimbursement that got changed short term for telemedicine because of the crisis will probably be made permanent. Fingers crossed, at least. But I think you've had Seema Verma and other people saying, "Oh yeah, this is a great idea. We should have done this a long time ago," whatever. So I think all of those things are going to contribute to just a permanent upward phase shift in the use of telemedicine and the application of telemedicine to other business things. Like I had an email exchange today with somebody doing telemedicine for hearing aids as an example. Okay, niche thing, right? But why not? Why do I go to the audiologist in person if I'm not going to go to my primary care in person?
Terrific. We have two more questions. The next one comes from Joseph Muldoon. Joseph, how are you? I know we've met, I think, through Bruce Strobsy a few times in the past. And the question is, how long will VCs wait? And I'm reading that to mean, how long will VCs wait to get back into the game at a relatively regular basis?
I could make a quick comment on that only because I've gone out, I've been talking to a lot of fellow VCs or whatever, and I think there's a cluster of VCs like us that never waited. And then I think there's another one that said, we're just going to take a 3-month pause. We're going to relax and focus on our own families and that kind of stuff for 3 months, and then we'll get back in the game. So I actually think sometime this summer, everybody will be back up to speed.
I would agree with that.
No, that's great. And again, great to hear from the experts on that for everybody involved here who's looking forward to that coming back. The fourth and final question is from Rick Pierce, who asks, do you think early stage investors, so we're early stage investors, and I'm assuming, Rick, you mean with smaller investment numbers and smaller funds and smaller investment numbers, will be more likely to make investments and deploy capital rather than as opposed to the larger funds that typically do maybe later stage and larger deals. So is there any reason to believe that the smaller, earlier stage deals will get done more readily than the larger, later stage deals, if I'm reading that correctly?
I'm not saying that, I hate to say it, but I mean, that as I said in the upfront discussion, you see a lot of trends toward, more conservative investments, which generally translate to later stage or more mature companies. And you see that both from the IPO perspective, where more and more companies are shifting, investors are shifting to companies with later stage products in clinical development. You're seeing that, and I think you're seeing that from the M&A side too. So I think you're seeing a shift that way. Look, they're always, for good, really outstanding technologies, people will always invest. So I will say that.
I agree completely. Yeah.
Terrific. I do see one final logistical question. Somebody had asked if the slides will be made available, and the answer to that is yes, absolutely. We will send out to everybody following the webinar today the slide deck that had been put up and people had gone through, which also contains the contact information for all our panelists. So I'm putting words into their mouth, but certainly feel free to reach out directly to any of them with follow-up questions. I'm sure they'll be thrilled to talk generally about specifically and help answer questions. So we're just about at the 1 hour mark. Let's do a sort of a quick wrap up, and then we'll transition into our networking breakout rooms. So I do want to thank our panelists for taking the time to do this today. The good news again about the virtual reality here is that we were able to put this together fairly quickly, which was nice, but at the same time, it's a lot of time on everybody's part, particularly the panelists. So we really do appreciate it. We hope that all of our guests have learned something today, have come away with some good answers as well as some good questions. We will, as I mentioned at the outset, in addition to the cocktail type events that we hold at JP Morgan and Boston Biotech Week, we also offer a growing number of substantive events, much like today's presentation. And again, in this new world of everything done virtually, we expect to be accelerating that a little bit. So we are in the early stages of planning for probably a Q3, a fall panel. It may be something along the lines of a CEO forum or something like that. Certainly, if any of our guests have either ideas for panels, ideas for speakers or otherwise, or want to volunteer themselves, certainly please reach out and let me know. And I just want to mention one other thing, which is that in the week of September 14th, which was supposed to be Boston Biotech Week, which I am assuming is also being held virtually, if at all. I haven't seen anything about it yet. There are two conferences that Burns & Levinson has been participating in over time a little bit, but we're going to be getting much more involved this year. We're very excited about the opportunity. So I just want to let people know that during the week of the 14th, the RESI Digital Conference, which is rediscovering early stage investing in the life sciences space, and a new sister conference that same week, 4D in AI, are going to be offered. They'll basically cover the entire week. We're going to be sponsors of both those, but more importantly, we will be moderating some panels. We will have some of our own life sciences folks, both on the corporate and the IP and the FDA side, making presentations and involved in panels. So we're really looking forward to that and hope people can join. Again, gives us an opportunity to help share our knowledge, share our network, and ultimately introduce those two terrific panelists like we have here today.